Okay, here we are back again today, and we're in our trade. We are officially short the euro dollar US dollar. And let's take a look here. Let's go down here to, okay, so we are 38 pips to the negative currently. And judging from the looks of this, we've been about 53 pips to the positive. So we've had an opportunity here to take profits if that is what we wanted to do. We wanted to stay in this trade longer for the purposes of demonstration and not set any trailing stops. We'll pop in here to the hourly and take a look real quick. We broke through here and sold off. Went down nicely. Now actually when we were 53 pips to the good, we could have actually placed a break-even stop right back here where we were in the market before, if, again, our trading methodology was calling for that particular type of stop. Okay. Now I'm going to start on the larger time frame. We're going to work our way back and look at a few things, and we'll also talk more about stops and stop placement as well. The monthly chart right here, we're taking a look at the monthly. I just wanted to make that a little larger. You can make your adjustments here by zooming out or zooming in. Zoomed in for a taste here. On the monthly chart, again, it's been a strong upward move, strong downward move, strong upward move. And we haven't broken out of the previous month's high or low. So there's nothing really significant happening. We're really in the middle of the range here. Okay. All right. Pop over to weekly. Here we go. All right, into weekly. Now we were previously short based on a weekly chart because we found a weekly chart pattern, and we found a weekly bar that was small enough to fit into our risk parameters at the time. So we sold at the break of that weekly low. Now here, as it happens, we're selling the break of this weekly low, and it has broken down. So we have some negativity there, as evidenced by the red candle, but it's early in the week. Now here's what we really based our trade upon, was the daily chart, placing our stop up here and our entry point right down here. So again, we came out a little bit to the good, then the market moved back up against us, and this is where the market is now. It's about 1/4 of the way back up to where our stop is. And we're going to leave our stop in place currently because it's based upon what we've got drawn up here, where the market had a little problem getting through that as our resistance line. It did break through support, and we sold based upon that. Take a look at the 4-hour here. Top-down trading again. Had a nice size bar down, and then a turnaround bar. And this is the reversal bar here, actually. It's the bar up. Then we move up, and here's where we are right here so far today. Okay, we can expand that if we want. Since we've been expanding them, we'll take another look at it this way. Now here we are. We've come down here. We started to move up, and we really are kind of meandering, but then we do have a push back into the territory here inside of our trade. In fact, we take a look at that on the 4-hour, we're inside of that, of our, back inside of our channel. We make profits when we get outside of our channel. We make losses if the price goes up to this point. And it's important for you to see these numbers. Again, that sometimes the market will immediately go with you and you're in a profit, and there are times when it simply will not look back and it'll continue in that particular direction. In this case, it went nicely with us, and then it reversed and went back and moved in the opposite direction. So that again is, a natural part of trading. One tendency that many traders tend to have is to want to move the stops. And it's, believe me, it's quite natural. No one enters into a trade and go, hey, I immediately want to lose. That's not how any trader's mind works, even the most successful traders. So the tendency is, wow, you get a little bit to the good. I'm going to, protect my profit here. And you keep hearing sayings such as, you can never go broke taking, a profit. Well, that's not exactly true. The account equity, which is the sum total of the amount inside of your accounts, and follow the arrow here, we'll go down to the bottom here. We're about 85 pips to the good in our account. That's thus far. Okay, and that's the equity. Your account equity grows when the sum total of your winners is greater than the sum total of your losers. So, for instance, if you have a series of winning trades and they all add up to $15,000, and all your losing trades all added up to $10,000, then you've made a $5,000 profit on top of your initial equity, whatever that might have happened to be, what that might have been at the time. So the tendency, again, as we stated, is to want to do something all the time. And you can do that, again, dependent upon your trading methodology. You can set your stop to break even. You could set your stop back here, and you could trail it along these highs here. I'll give you an example of what that looks like by putting some horizontal lines down. And you won't be able to put very many down because it didn't go very far in our direction. But once it got down here, you could actually do that, and you'd be able to pull a profit out, which at this particular time, that doesn't look like such a bad idea, does it? Wow, we could have grabbed a profit instead of being currently in a loss. Well, a lot of things happen in the middle of a race that don't really have anything to do with the outcome of the race. And the market's moving to and fro, fluctuating as we call it, is completely natural. Giving the market enough room to move, that can be the challenge. That could be the challenge, especially for individuals with smaller account sizes, but it could be the same challenge for, let me erase that line, for people with large account sizes if they are risking too large a percentage of their equity per trade. Okay, that was a long-winded way of saying we don't have to do anything with our stop. We're going to leave this trade as is. We're going to leave our stop up here. And yeah, we could actually trail it down to any number of these points in an effort to reduce our exposure. And some people will actually go through and move not only a stop to a break-even point, but a stop to points such as these, that high, then down to that high, then down to that high. Of course, someone would have been stopped out at that particular point. And that's called a trailing stop because it trails or follows the price action. So a trailing stop on a sell gets lower and lower and lower and lower as the price moves down. Going upward, a trailing stop gets higher and higher and higher and higher. And a trailing stop is designed to help the trader preserve the profit or capital in general. And it's a very useful tool when we give the market enough room. Now you can imagine having a trailing stop that's 1 pip. Quite obviously, it would have to be a very slow moving market for a 1 pip trailing stop to be effective. I would venture to say you get stopped out a lot trying that. So with all that in mind, and again, the long-winded way of saying we're going to have to be patient and we're going to see where this trade goes. Now, the possibility that the market can move all the way up here and stop us out is there, as well as move down from here and get us into a better get us into profit and a better position. So what we're going to do is we're going to leave this trade and we'll come back to it and we'll take a look at it and we'll see where we are from there. Thank you very much, and I'll see you in the next module.